What's that? All right. Well, hello, everybody. Now I got to tell you, I can't see anybody out there. So I don't know if you're there or not. I heard some voices, so hey, welcome. Well, I do want to welcome you to our State of the Market 2026 today. I know your time's valuable. To come uptown's a little bit of an experience. But the fact that you came to spend some time with us as part of your day, it means a lot to us and the team at Hobart Wealth. And I just want to take a minute as well and thank all of you just for trusting us. The team, every day we do what's called a stand-up. And we share different stories when clients come in and, different adventures they're on or different things that they're experiencing. And it's always fun to hear the cool stuff you guys are doing because you're the reason why we do what we do. And I appreciate you all trusting us enough to do that. We really don't take that lightly, and it's something that we really enjoy just being able to work with each and every one of you. Now, if you're new to our firm, welcome. We're going to kind of give you the rundown in a couple of minutes. If you're an old timer with us, welcome back. I was thinking about it today as I was putting some notes together, and I thought, man, oh man, it's hard to believe that we've been around over 20 years. Because I remember when I started the company and I had this vision that was just kind of small, kind of insignificant, and to see how we've grown and the people that we serve and the team that we have just gets me excited. And again, I'm just happy that we get to work with folks like you. Now, our event today is called the State of the Market 2026. We did not plan it to be the same day as the State of the Union address. I'm not going to lie. There was this brief moment where I was thinking, I need to walk down the aisle with the presidential music going, and I thought it'd be cool to shake hands and kiss people, and then have half of you not clap for me and half of you clap for me. I thought that'd be epic. It turns out that my team said no. So instead, here we are with the State of the Market event. Today's really going to be a chance for us to zoom out a little bit because markets, they move fast anymore, right? Headlines, they move even faster. And a lot of times it's almost like we as in all of us are expected to know what to do with all the information that's consistently flying at us. And it can be difficult. So today we're going to take some time, and it's really about trying to get us grounded and give us a little bit of perspective and context and just some clear thinking about what's going on in the markets and how it applies to each and every one of us. Now, before we jump in, I did want to share just a couple of things that are just important to us. So over the past couple of months, one thing that as a team we have been doing more and more is just focusing on client feedback. You all should remember back in November, and I hope everybody filled this out, right? We sent out a survey to our clients. We've also been asking clients in their meetings. We also have a client advisory board where we've asked some very specific questions just about the type of service that you receive and what we do. And I just want to thank all of you because we got so much feedback from so many different people. And when clients tell us what we're doing well, that's a pat on the back. But more importantly, when they tell us where we can improve, that gives us something to shoot for. And I want to kind of address some of that too, because one of the themes that we heard in the area of the good stuff, which feels good, is that you all value who we are and what we provide for you, and that we're steady, and that we've got a professional and dependable perspective. We love to hear that, and we're going to continue to deliver on that. But the other piece that I wanted to just talk about real quick before we get the show started is another clear message. And the message that we heard was, as Hobart Wealth grows, how do we make sure that we keep our interaction with all of you personal and proactive and also high touch, as you've come to expect from us. And we also heard from you that you want a lot more like real education. And that's why we're having an event like this. But we also heard from you that you want to have like behind the curtain type of views of what we're doing at Hobart Wealth. So we're going to be working on that. And I'm going to be sharing some things a little bit later on today as to some of the stuff that we're going to be doing. But we are listening to you, and we are going to proactively try to give you some more of that great education going forward. So the first thing that I do want to talk about around the area of growth is capacity and service. So as we grow, the one thing that we're focused on as a team is making sure that we can always improve our client experience. Sometimes we're not always going to hit the ball out of the park, but guess what? We're going to try, and when you give us feedback, we're going to do better. You may know this. This is called our Golden Paperclip Standard. That Golden Paperclip Standard is an attention to detail, it's responsiveness, it's making sure that you feel cared for and not just like you're part of a process. So to do that, we've actually added some new team members. And I just want to highlight a couple of those folks because in a day where scams and all that type of stuff happens, sometimes you get a phone call and you're like, who's calling me? Are they actually from Hobart? So it's good for you guys to know who we have. So two of our newest hires that we brought on this past year, Josh and Sadie. Now, Josh and Sadie are both associate wealth advisors, and I don't know, they might be out there. Again, I can't really see too well. Josh and Sadie, if you're out there, wave to the crowd. But Josh and Sadie are both members of our different diamond teams. So as clients, you work within a diamond team. You're either on Corey's diamond team or you're on Andrew's diamond team. Well, Josh works on Andrew's diamond team and Sadie works on Corey's diamond team, and they're already making a big difference behind the scenes, and we're already seeing some good impact. But just know if they reach out to you or call you and need some additional information from you, they are calling from the team, and they're there to take care of you. A couple other faces that you may have noticed as you came in today, Brian, and Brian's got a great story as to how he actually started working at the firm. I'll let you ask him about that because it's a pretty neat way that we met him as well as how we brought him on. And one other person that's new to us is Lisa. Now, have a lot of you had a chance to meet Lisa at the front desk at the office? Is she awesome? I got to tell you what, every once in a while you bring somebody into the office that is a highlight for the team, but also we get to get such phenomenal feedback from our clients. And it just is a reminder of what a difference the people make and that extra piece of caring has. And that's really what we're trying to do more and more, which is aiming for more opportunity to show you where we care, how we care by bringing folks like Lisa and the rest of the team to the table. The second thing, again, I mentioned education. But again, we're expanding on educational events. We're going to get your feedback coming up after this event so you can share with us what's most important, because we want to share content with you, not just about what's going on in the market, but things around real life decisions. So today is part of that, but really going forward this upcoming year, expect to hear a lot more from us on different topics that are important to you. And we're going to have kind of some high level things, and then we're also going to have some things that go a lot deeper, because we've heard from a couple of clients that you guys just really want to know the nitty gritty of some of the stuff that either we're doing or financial planning, and we're happy to share that with you. Last introduction, again, this goes in the area of new folks. You're going to see Chip Randall today, and he's going to be moderating our Q&A that we have coming up. Chip's in charge of our education, our presentations, and he's really that glue between clients and advisors and having questions and answers and the conversations like we're having today. And you're going to see that come out in the Q&A section. So, all right, that's all my announcements for today that I wanted to bring up. Now we actually get to. Oh, actually, I do have one other announcement because this is kind of special for me. There's somebody in the audience that doesn't always get to attend these. I don't know if he's just snooty or he's not proud of his son, but my dad's here, which is really kind of cool. So Dad, wave to the crowd. In the back corner there. Now, the reason I have him waving to the crowd is I want you all to avoid him. He's going to tell you he's the good Hobart. Trust me, I'm sure he's already used that line once or twice today. All right, let's get into the program today. In a couple of minutes, I'm going to have, actually, let me forward this. There we go. In a couple of minutes, I'm going to have Jacob Woodrum come up here. He's going to introduce our speaker. Now, our speaker is going to walk us through really what's happening in the economy and in the markets right now, and really focus on what matters, a lot of what doesn't matter, because there's plenty of that, but then how to think about it in the environment that we're in. And after that, we're going to be moving on to the next segment, which is going to be the advisor Q&A section. And that's going to be where we have Andrew and Corey and Jacob, as well as our speaker, I believe, is going to be able to attend that as well, to answer questions from all of you. So here's the deal with that. We want this to be real. We don't have any packaged questions. If you've got something on your mind, chances are somebody else is thinking about it. There is not a question that's going to be too simple, and there's not a question that's going to be too difficult for our panel to handle. So that's my challenge to you. Think of those good detailed questions and we'll throw them at them. A couple quick housekeeping notes. If you need to use the restroom or anything, I think you guys know where they are. If you need some refills and some desserts, I think you know where those are at as well. And again, if you have any questions while the speaker is presenting today, do me a favor, no hands up, because one, we can't see you from up here. But number two, write it down on the pads of paper that you have, and you can ask those questions during the Q&A section. Did you guys not get pads of paper? Oh, well, great. You know, you do everything right, and then somebody says from the crowd, what pads of paper? You had to do that to me, didn't you? No, that's, I heard somebody else say, type it in your phone. Who was that? Well, whoever said that, I think I know who it is. Well, thank you. Yeah, type it in your phone or keep it in your memory, because during the Q&A section, that's where you're going to be able to do that. Sorry, I did think we had some paper for you, but I guess we didn't. Oh, okay, well, we're not going to worry about it. All right, we're going to get this show started. Jacob Woodrum, our lead investment strategist, is going to come on up, introduce our speaker, and we're going to go from there. Thanks, Jacob. Thanks, everybody.
Thank you, Chris. Thank you all for being here. It's wonderful to see everyone. I've had some great conversations already, which is, it's very exciting for me. I think, we will do a lot of events where you get to see me and Chris virtually. You might talk to us over the phone, but it's just nice to be able to see everybody in person. And Chris was not lying. I really can't. It's hard for me to see you guys with these lights. So anyways, so markets are evolving constantly. And the importance of process and clarity, is really what we're going to talk about today, not reaction to that. And you guys, I think, all know this about me, but for those of you that don't, my main role and responsibility is to really oversee the wealth that you entrust to us. And so that means a little bit different things for different people, but on a high level, it's specifically how do we invest according to your risk comfort level? How do we pick investment strategies that are appropriate for you specifically? How do we allocate capital efficiently? And it's really, the importance of that really revolves around what I would call our kind of internal investment committee. So that's really one way that we really drive that process. What I'm excited to have to Andrew, our speaker today, share with you is really what we see in the economy and the markets, and specifically the U.S. economy. But I did want to take a moment to highlight and really touch on the partnership that we have with the company that Andrew works for with his First Trust. And two things that I think are really important about that. One is, I mentioned we have an internal committee, and that's really important, but the importance of also having what I call kind of an external investment committee that allows us and myself to say, okay, here's how I think we need to be positioning based on the markets and the economy, but let's also recognize where we may be missing something and also have an external partner, what I call a trusted thought partner, to help us in that process. So not only do we have that with this company, but we also have a portfolio analytics support as well, which helps me and helps our team as we're building out our portfolios and structuring our investment strategies. So I'm excited to share with you that Andrew Updike will be sharing a report with us and an outlook on the economy and the U.S. economy specifically. He's a senior economist with First Trust. It's interesting, Bloomberg has ranked him and his team as a top U.S. forecaster of the economy over the last decade. And I had to throw this in here too, but he's a fellow CFA charter holder. So really excited to have Andrew joining us today. I'll go ahead and bring him up, and let's go ahead and welcome Andrew Updike.
All right. Good afternoon. I know what you're thinking right now. You're thinking, wow, we got a great venue, we had some nice food, and now I get to listen to an economist. Could the day get any better? And the answer is yes, because I talked to the team right beforehand. I said, how long do you want me to go for? And they said, well, how long do you normally talk? I was in Sacramento last week. I did a talk last Thursday night. It didn't go much over 2.5 hours. And they said, 30 minutes sounds great. So here's what I'd like to do. As an economist, and I'm sure many people, economics was their absolute favorite class growing up. No? Any hands? No. Yeah, one or two. Yeah, the two that made it all the way through that class. In economics, here's what we do. We spend a lot of time looking at history. It's interesting to me, I've been on the First Trust team for about 15 years now. I spend a lot of my time traveling. I'm on the road 40 to 45 weeks of the year. I cover the continental United States, but I also cover internationally. I cover markets in Mexico, Chile, Peru, Canada, and Japan. So I get to see some of the outside view. I get to talk with the pension funds, the life insurance funds, the investors internationally to both understand how are things operating here on the ground. How does that compare to the data that we get when we turn on the TV? You turn on CNBC, you turn on Bloomberg. But then I also get to kind of talk to many of you. And we use that in our forecasting, understanding what is beneath the details. Because I'll tell you, especially right now, over the last 3-4 years, the data that you hear when you turn on the TV and what the data underneath that shows has deviated to a degree that we haven't seen that often in the history of the United States. But when I look at all this data, I start with the mindset of history because so many things we've been through before, okay? And one of the people who's been so critical in my life, my understanding, is my wife's grandfather, Grandpa Dahl, who just in October turned 102 years old. 102 years old. Do you know what he did to celebrate his 102nd birthday? He got his driver's license renewed. I swear, he got his driver's license renewed. He went and got his hair cut. Then he met us for breakfast and said, don't tell my other daughters because I promised them I wouldn't drive anymore. So hopefully they're not watching. But Grandpa Dahl, he showed me some stats, some data that I had never seen before. And I want to start with this because I want context. He said, Andrew, we're talking at his 102nd birthday. He said, Andrew, I watch my kids, my grandkids, and he had 17 great grandkids there at his 102nd birthday party. He said, I see the world that they grow up in, and it's so different from the world I grew up in. What they are experiencing, I could never have imagined. And I would talk to him through COVID. I talked to him through things that were going on in the financial crisis. I've talked to him in recent years. Right? There's always stuff on the news, and I'm always like, Grandpa Dahl, how are you doing with all this? And he goes, I'm like, what do you mean? He's like, Andrew, let me show you something. So this is one of the first slides that he ever showed me, and I want you to take this in for a second. Right? Because we spend a lot of time thinking about politics. We spend a lot of time looking at what's on the news today. I want you to comprehend and I want you to appreciate that we sit here at a period of time where it hasn't been that long. If you look at it, right, it was in the 1960s that for the first time in the history of this planet, more than half of the world's adult population was literate. It's been within the last 65 years, the first time ever that more than half of the world's population was literate. Was that because people didn't want to read before? No. A lot of it was because they didn't have the resources, they didn't have the time to read, right? And he said, look, here's what happens, Andrew, is I've watched this now. Remember, he's 102 years old, which means he grew up, he lived through the Great Depression, he fought in World War II, he fought in the Korean War, his kids fought in the Vietnam War, he went through all of the inflation, all the disturbance in the 1970s, he watched the Berlin Wall fall down, he watched China open up, he watched Russia open up, he went through the market crashes in the 80s, the dot-com bubble, 9/11, the financial crisis, COVID, Brexit, the BP oil spill, H1N1, and Zika. And I'm like, Grandpa Dahl, like, what? Through all of that, what is your greatest piece of advice to the next generation? You know what his number one piece of advice was? Turn off the TV. He said, turn off the TV. He said, when you think about that this is going on, right? Think about what happens when you give people, when the education, sanitation, nutrition has improved. We've got more people today who are better educated than they've ever been before, and he says this happens. I don't think it's coincidence that these two charts move in opposite directions. The percentage of the world's population living in extreme poverty, and the inflation adjusts this over time. You'll notice there's been this dramatic correlation between our capacity to learn, the availability of information, the access to information, and the progress that we have in terms of improving outcomes. And so I always have this in the back of my mind because I never forget as I travel, right? That whether we're here or in Chile, Lima, Mexico, wherever I am, right? That we're sitting here at a period of time where there are more people than ever before who are better educated, better fed, that are working on the world's problems. And that unleashing of human potential, possibility, is absolutely incredible. And as I sit here and talk with Grandpa Doll and I think about my own kids, I never lose sight of this. Now, I also don't lose sight of the fact that here's us, right? This is the United States. If you stop and look at the US markets, if you think about the earnings, the progress of these companies, it goes from the bottom left to the upper right. And yes, we have our ups and downs. And some years the markets act logically. Sometimes psychological components take over. Sometimes the markets put the psycho in psychological. Okay? There's years, if you see 2018 in there, right in the middle of the chart. You see 2018 where the activity bumps up? Where earnings jumped about 15, 20%. Well, if you step back in time with me to 2018, do you remember what the markets did that year? They fell. Now, that was the year that the original tax cuts went in place. The corporate tax rate went from 35 down to 21. Earnings were up, but there was other concerns. People said, yes, but there's an escalation in trade tensions with China. Yes, but we had a government shutdown. And I said, yeah, only the 86th one we've had in history. Okay? And then people were worried because the Fed was potentially going to move. It's amazing because some of these concerns are back again and people say, but what if? And that year, those fears overwhelmed. In fact, it got so bad that during the shutdown, CNBC put a little ticker on the corner of the screen. And it said, every day that the US economy is shut down, it subtracts X amount from GDP. And they ran this thing day after day after day after day after day until the data came out and it turns out they were completely wrong. Okay? And I'm sure you remember that day because that's when they ran the apology special. No, they didn't run an apology special, right? What did they do? They moved over to whatever was going to be the next thing that sold advertising, freaked people out, and brought them back from the commercials. Now, what happened in 2019 is that earnings barely moved, but the markets recovered. Again, the timing of it, you can't always tell when the markets are going to move, but you can look at these underlying fundamentals. And I wanted to show you this chart early on because I want you to understand how unique our situation is. We are the world's leaders in technology. We are the world's leaders from a financial system. In terms of what we do, what we build, how we grow, and this is not Democratic or Republican, this has nothing to do with the politics. This is the reality that our system with private property rights, rule of law, the democracy, we have, celebrating 250 years as a nation this year, we have been, from an economist perspective, the single most successful economic experiment that has ever happened on this planet. And I want to show you what the rest of the world has seen over this time period. So note, ours starts at $40, $50, $60 per share. It goes up to about $360. This is the rest of the world. Now, I had to bump their left-hand side. So they also start at 50, but notice they don't go to 400. They go to 200. And notice this time period from 2010 up until about 2022, they stagnated. There was very little growth. It was up and it was down. And it wasn't just in their earnings, it was in their GDP, the quality of life, the outcomes that were happening in these nations. I want you to remember that through everything we've gone through and continue to go through, whether it's politics or whatnot, right, that comes secondary to the work that's happening behind the scenes. That so much of what you do, what the people do, the progress that's taking place doesn't get enough of the attention, but is very much happening. Now, when I think about 2026, I keep getting a couple questions. Well, we just had tariffs in the news. What are the tariffs going to do? And my question was, what have the tariffs done? What have they done so far? I love data, okay? I'm a nerdy math person. I'm one of those people that when the Federal Reserve holds a press conference, I pop popcorn, I grab a Diet Coke, I get excited. It's like my football on Sunday. Okay, didn't get invited to a lot of college parties, but I love the data. Right? And I said, well, let's look at what's happened. Here's your data. With all the things that happened last year, with the tariffs going up and then down and then up and then going down, right? I remember on Liberation Day when Trump walked out and he put out his charts and he said, we're going to tariff all these countries. I'm like, I don't know who some of these countries are. I've never heard of the McDonald Islands. So I looked them up. Do you know their population? 0. It's penguins. And I'm like, man, they must have got us over on a trade deal at some point. But when I look at this data, you tell me this. Look at the imports. Look at the exports. Do you see a massive shift in activity? I look at this and I say, you know what? There's some, right? We definitely saw some improvement on the export side. The imports, they got a little bit better, but we're still bringing in a lot from the rest of the world. And I looked at this and I said, so is the takeaway here that they didn't really matter? That they didn't have a lot of impact. Now, I'll tell you from spending time looking at this chart and then the data underneath it, I don't think this is what we should take away from last year. I think the more important activity happened here. Okay, so here is the US largest trading partners. Here is who we do the most total activity with. Mexico's number 1, Canada's number 2, China's number 3. You notice these numbers in parentheses that are running down the left-hand side for you. Those numbers are the trade deficit, how much more we bought from these countries than we sold to them in Q3 of 2024, okay? And what I'm gonna show you, I'm gonna click the button, you can play along, right? We're gonna figure out whether our activity with the United States, if it moves to your left, it means we close the trade deficit with that country. If it moves to the right, it means we move deeper into trade deficit with those countries. So I want to understand, behind the numbers, did we see anything meaningful happen? I'll give you an example. So here's Canada. Canada, $9.9 billion in trade deficit in Q3 of 2024. We went through the discussions with them early in the year. Over the next 12 months, that trade deficit got cut roughly in half. It fell by about $5 billion. Now, we didn't have a big trade deficit with Canada, but this was one of those early pieces. What about China? China's been an ongoing. China's been kind of this feud that's been going on. It goes back before this administration. It goes back to Trump 1.0. And remember, Trump 1.0, he put in tariffs and he said, look, I think China misunderstood the word copyright. I think they thought it meant the right to copy, okay? It was a translation issue. And they said, look, you're a developing market nation. As we grow, as we build products, it doesn't make sense to us that Apple puts out an iPhone and then 2 weeks later there's a Peach phone that shows up in China that looks identical to the one we just put out. We put time, effort, resources into building that, right? We've got intellectual. So we've been having this movement where we said, China, we need you to work on the same. We've got international trade laws. We need to work on the same page. So China's the area we run the largest deficit. How did that move over the next 12 months? Do you think we moved deeper into trade with China, or do you think we moved away? We moved a little bit away. Or maybe it was more than a little bit. How much do you think this number moved? 5 billion? 10? 15? 20? Well, here's the number, okay? It got more than cut in half. Did you know this number? It's funny because I never saw it get reported on TV, but I said, wow, that is a significant movement to happen in 1 year. Now, if you looked at the import data, and that's what we largely do from a place like China, is we import a lot of things. So I said, well, it's not just that we got rid of everything. It's not that we stopped importing and produced it all here. Obviously, we started doing some with other places like India. Now, this is when India was under the 50% tariff, but they said, look, we want to negotiate. We're going to try to figure this thing out. We want to grow with you into the future. They've got a lot of engineering talent. They've been building the infrastructure. That's a major piece that India needs, but they said, we want to partner with you. Then you've got Mexico. Mexico, part of that original spat that was going on with the US and Canada. But at the end of the day, through everything that happened last year, we ended up deeper in trade deficit with Mexico. We do more imports and more exports, but the imports grew faster than the exports. Through all the bluster, all the words we heard on TV, I said, what did the actions show? What are people doing? What are the companies doing? Now, what are they saying? What are they doing? And then you look at places like Taiwan. Taiwan, the semiconductor manufacturing capital of the world, obviously with everything going on AI, and we'll touch on AI. They saw a movement towards but they said, hey, look, we know you're buying a lot of chips from us. We also want to participate with you. If you look at what Taiwan has done, specifically TSMC, their semiconductor manufacturing corporation, they said, we're going to spend $250 billion to build in the United States. We are going to build our factories by you. We want to work with you on this into the future, because what they've been doing is we've been designing the chips and they've been building them. So we struck up the relationship here, and then Vietnam has become the soft goods manufacturer. I would argue the most important takeaway on the trade front last year was not whether we did that much more in imports or that much more in exports. It's who did we do the trade with? And when I travel and I talk with businesses, this is the question I've asked them. Where are you building? Who are you building with, not just for this year, but into the future? If you're going to build AI, if you're going to build manufacturing, if you're going to do production into the future, where are you getting it from? Who do you trust? And they said, this is what we've been doing. It doesn't totally reflect in the numbers, but these are big moves. Now, the EU is an interesting one. They came and said, well, what about that Greenland thing? I have no idea what's going to happen with Greenland. Okay? But they said, well, don't push too hard on Greenland. We might pull back on trade with the US. And so again, my mind immediately goes to what are the numbers? How much trade do we do? Q3 2024, $40.8 billion trade deficit with the EU. But then over the next 12 months, that number got cut by 3/4. I said, this is really, we need to know the data. We need to know the facts. We have to understand what has taken place and what is taking place to understand some of the direction on where we're going. Now, when I would talk with people about tariffs, they didn't usually ask me this question. Or when I turned on the TV, it wasn't usually about this. The question on tariffs was, will it cause inflation? And this was an interesting one because as an economist, inflation is a major part of what we study. So I looked at the data and I said, well, did it cause inflation last year? Here's the inflation numbers, the CPI, Consumer Price Index. So they survey thousands of families and say, how much did you spend last month on your house? How much did you spend on your car, your food, your clothing, right? We want to understand what your monthly budget looks like. And then they run those numbers, they check those items throughout the year to understand, and they give us the numbers. So here's CPI year over year. And what I noticed is we didn't see a whole lot of inflation last year. Inflation continued on the path that it was on beforehand. Does that mean that we didn't see any inflation? No, right? If you think about it, let's say that because of the tariffs, a microwave got more expensive, right? Because we're bringing in components, let's say from Mexico, and that steel, the aluminum that goes into the microwave. So on goods prices, it did rise. But now think about what you do when something like that happens. If you, let's say, heaven forbid, your car broke down today. You drove home tonight, you went to sleep, when you woke up in the morning, your car would not start. It was completely dead. I had nothing to do with it, okay? If this happens, it wasn't my fault. But let's say that you go home and tomorrow morning your car won't start, and you call a tow truck, they bring it to the place to fix it, and they say, we can't do anything. The part that's needed to fix your car disappeared off the face of the earth. We have no idea where it went. And you said, oh my goodness, car prices have gone up because of the tariffs. Well, maybe I'll get a rental car. And they say, I don't know what happened last night, but all the rental cars disappeared too. All of the rental cars, all the used cars, you're going to have to buy a new car. So now you go out tomorrow, and let's say a used car costs 10% more. Let me ask you this. Because of tariffs, did your incomes go up 10%? No. No, incomes were up about 2.5%, 3% nationwide last year. If you have to pay more in order to get the car, are you going to pull back in any other areas? Are you going to maybe eat out a little bit less? Are you going to maybe say, okay, well, I was thinking about doing this trip, but maybe I'm going to hold off because I have an obligation. I have to pay for this. I'm not going to borrow. I'm going to shift my spending. And this is what happens. This is what happens. And it's not just now. Go look at 14, 15, 16. Does anything stand out in 14, 15, 16? No. But let me remind you, that time period is when energy prices fell from $100 a barrel down to 40. The single most used commodity in the United States fell in price by 60%, and we didn't see deflation. We adjusted where we spent the cash. So services last year saw that number fall. And I think this year we're going to continue to see some downward pressure on inflation, and here's the reason why. Housing. Now maybe you're thinking, but I haven't heard much on housing recently. You need to understand in this place, we don't use home prices. I'm not the one who sets what gets used, but the BLS, the group that does the reporting for the United States, says home prices is not what we use to measure inflation. The reason being, you buy a home, you sell a home, you typically sell the home for more than you bought the home, and they said it's an investment. How can we got to figure out a way to measure prices where you don't own it at the beginning, you don't own it at the end, but you use it for a period of time. And somebody said, that's rent. They said, that's great, let's use rent. Now, think about this. Let's say that home prices had gone up 20% in 2020. Let's assume, think about this, if you had signed a new lease on an apartment on December 19th, or December of 2019, you signed a 2-year lease, and then home prices went up 20% in 2020. How much did your lease payment move? 0, because you signed a 2-year lease. If prices had collapsed, you also would have still had to pay that amount. Rents move with a lag because they don't come due immediately. So what happens is home prices move and then rents move, but we're not quite there yet because when we measure inflation, we want to look at the average family in the United States, and not everybody's resets at one time. So what we do is it gets leveled out over time. So what's really interesting, at least interesting for an economist, is that home prices move, but you don't see it in the data until 12, 18 months later, because of the way that it's calculated. It's visible to us. Home prices went up. It's more expensive in my area. But at the end of the day, what they measure is how much are we spending. So you'll notice what happened with home prices when they went up. They went up first for home prices, then with rents, and then with that CPI, that shelter index. Then what happens on the way down? It starts falling first on home prices, then it flows through to rents, and then it flows through the shelter. Well, look at what's happened with home prices over the last 18 to 24 months. It's moderated. And so mechanically, because of how this flows through the system, this is going to flow through on the inflation numbers in the first half of this year, which means the inflation numbers are not likely to move up substantially. In fact, I think you'll see a little bit of moderation. Now, I don't think the Fed is going to cut rates at the beginning of this year. I don't think they have plans to cut rates right now. And Jerome Powell, who runs the Fed, he's the chairman of the Fed, his term is done in May. They're unlikely to do much of anything before his term is up in May. However, the person who comes next, which right now looks like Kevin Hassett, he needs to go through and get confirmed within the Senate, within Congress. But as it stands right now, right, anybody that Trump was going to nominate, do you think Trump was going to nominate somebody who said, I think we need to raise rates? No. In order to have your foot in that door, he was like, well, I hope you're somebody who wants to cut. Now, maybe you're thinking to yourself, but Andrew, the Fed's not supposed to be political. And I completely agree. I completely agree they should not be, but that doesn't mean they aren't. And if you go back through the history of the Fed, Jerome Powell, who's the chair of the Fed right now, back when he worked at the Treasury, before he came to the Federal Reserve, one of his jobs at the Treasury was to try to influence the chair of the Fed. So it's come full circle in some of that. Now, again, I think the Fed is less impactful than they think they are. I think they're less impactful than many people think they are. If you go back and look at the earnings numbers, you can't find a year and say, oh, the Fed did that. They're not coding. They're not building cars. Right? They can move interest rates, and that can impact some companies. But I think here's what's going to happen, is that the inflation numbers are going to come down, and later in the year when Hassett comes in, he's going to say, yes, the reason we're cutting rates is because we have a dual mandate. We've got employment and inflation, and employment is going to be the area. Now, you notice this chart, okay? You notice how it's kind of rounding off on the end. Now, they just gave us an update on Friday to this number, and I wanted to show you what the old number was, okay? So up until last Thursday night, they had said in 2025 we added 0.6 million jobs. Then they revised that number and said it was actually a little lower. We may have overstated. Now this was including some in 2024. They said we may have overstated jobs by a mere 898,000. Small miss. Now of that part in 2025, they revised this number down from 0.6 million to 181,000. For comparison, in 2024, the number was closer to 2 million. Okay, so 2 million versus less than 200,000. We were basically doing that number per month in 2020. Are these comparable time periods? Well, now you run into more issues, right? Obviously, tariffs had impacts, and so did the immigration. If you go back to 2024, of the 2 million, about 1.2 million of that was foreign labor that came into the United States to work. Last year, we didn't get 1.2 million new workers. We lost 800,000. So that number, 181, first they had to replace that 800,000 and then add. Last year, right, you can look at the employment market a lot of different ways. Domestic labor in the United States last year grew at one of the fastest paces that we've seen in a long time. But the headline number was lower. You'll notice the unemployment rate didn't move much. But is there a skills difference? Is there a difference between who left and who's here, who's coming into the market? Yes. So you'll notice industries. Construction's having a really hard time. There's a lot of service industries that are having a very hard time. When I cross the country, they say, we've got a lack of skilled labor. Now, I asked them, what are they thinking for 2026? And they said, well, people aren't really leaving anymore. We are starting to see a little bit of a shift in that. I do think the numbers will be a little bit higher, but I'll tell you, again, headline numbers, not where I would pay attention. Here's what I want to do. I want you to do a thought experiment with me, okay? So I'm going to put down this clicker. I want you to imagine that I have the power to put you in charge of the US jobs market. So here's how it's going to work, is every month, first Wednesday of the month, because the data comes out on the first Friday, first Wednesday of the month, I'm going to come in here, and I'm going to tell you how many jobs you can create, 200,000, okay? You're going to get to create 200,000 jobs per month. Here's what I want you to think about. Where do you put them? You can choose anywhere. You can choose any industry. You can choose any sector. You can choose any geographic location. You can put them all here in Charlotte. You better find homes for them, okay? But you can put them wherever you want. So I want you to pause for 5 seconds, and I want you to think in your mind, what are 2 sectors I would put at the top? Here's where I would put the most jobs. So think about that for a second. You got your sectors? What comes to mind? Healthcare. AI, technology, it's high margin, it's been high growth. What else? Construction, agriculture. A lot of times I hear energy. Can I ask, how many people in here had for their top 2, how many people had government in their top 2? Not a hand. What sector do you think was the #1 employment grower over the last 3 years? Government, and it's not even close. In fact, so there's 2 sectors, okay? 2 sectors have been dominating employment gains in the United States. Healthcare is one of them. Now you think, well, I like healthcare. The difficulty is that it's a subcategory within healthcare called social assistance. It's essentially the government-funded programs that are run through healthcare. This is not pharmacists, this is not nurses or doctors. And so if you look at this data, government and healthcare, now these two sectors are usually about 12% of job gains. Usually about 12%, they've been running 85% plus over the last 3 years. Now look at that orange line, the all else. Everyone outside of that, so this is all the construction, all the manufacturing, okay? This is going to include anything that's happening with AI or energy production. Notice how many times over the last 2.5 years has that side of the economy grown faster than that government and healthcare component? And the answer is 3. You notice them right in there. They're kind of put together. When was that? That's when the Fed started cutting interest rates and small, mid-sized businesses said, okay, we are interest rate sensitive. Our cost to invest in our people, our property, our equipment, as that number started to come down, they said, we're going to get back in. Now you'll notice the government and healthcare numbers started to come down. The government number in particular shrank. Healthcare is continuing, that social assistance category. If we look at jobs last year, I told you 181,000 private sector payrolls. Now these still get included under private sector. They may have government funded contracts, but it's private companies that are running it. The social assistance category was about 600,000 jobs last year, which means private X, take that out, it was down about 400,000. This is going to be something very important, and I think this is what the Fed is going to do later this year. They're going to say, hey, you know, we're going to think about cutting interest rates because we need to see this broadening out. We need to see the health in the economy. Now, real quick, okay, do I think that we need some government workers? Yes, my wife, full disclosure, is a government worker. My wife is a school teacher. I love her very much. But imagine for a moment that everybody woke up tomorrow, every single worker in the United States woke up tomorrow and was a school teacher. How long could we afford it? We couldn't, right? You have to have growth coming from this all else category to make the other two possible. And if it's lagging consistently year in and year out, if the growth is coming on the other side, the burden is going to increase, whether that's taxation or borrowing, adding to the debt. This is going to be a very important trend to watch. Now, I think we're going to see improvement this year, but time will tell. Meanwhile, look at what the companies are doing. This year is expected to be one of the strongest years we've seen on the earnings front. Now, this first orange line is 2025 because we haven't gotten the final Q4 numbers yet. But then you look at 26 and 27, and you'll notice the growth in those two is better than almost any of these other periods. And so we look back and say, well, the markets are not the economy is not the markets. There's some overlap, there's some areas, but think about this. If you're running into difficulty and you can't find enough labor, what do? They said, well, we're investing in AI. We're trying it. We're trying to use the skill of the labor that we do have. Now, they're investing massive amounts of money. This year, AI investment from the top companies, they're saying $650 billion. To put that number in perspective, that's roughly equivalent to Walmart's global sales. The annual sales of the largest retailer in the world, that's how much we're going to spend on AI. And so we've got a lot of eggs in some of these baskets, and that's brought volatility into the markets. Now, I'll tell you, I do have some concern about that, but I'm not as, some people have asked me, well, Andrew, but isn't AI, what about the disruption that's going to do to the economy? Isn't that going to take away jobs? Isn't that going to destroy industries? And I said, well, I spend a lot of time thinking about history, and I think about things like this, okay? Because we can prognosticate all day. This is one of my favorite articles from the New York Times. When they were arguing, why are we spending all this time trying to make planes? They said, why would we do, now, flying machines which do not fly. If you look here on the right-hand side, they said, okay, it may be assumed that the flying machine which will really fly might be evolved by the combined and continuous efforts of mathematicians and mechanicians in from 1 million to 10 million years. And this is an expert. When did this article get released? October 9th, 1903. Now here's my question to you. When did this happen? December 17th, 1903. So not 1 million years to 10 million. It was about 2.5 months. But then I saw that and I'm like, yeah, it is very, you never know. Remember the internet. Do you remember where you were on 12/31/1999? Do you remember where you were for Y2K? Did you have this experience? I was in Naperville, Illinois. It's about 26 miles straight west of downtown Chicago. And I was in our downtown, and we had our own ball drop. And as the clock was going down, 3, 2, people are like, oh my gosh, what's going to happen? Are the lights going to go out? Is my VCR going to start blinking midnight and that tape from Blockbuster's not going to work? And it was 3, 2, 1. What happened? Nothing. Do you have the same experience? Yeah, you remember the anxiety, the concern over. Now let me ask you this. How many of you were in North Carolina for that? I see a handful of you. How come I was in Chicago? I'm an hour behind you in terms of time zone. Yet none of you called us to say, hey, I asked this in Sacramento last week. California had no idea. Now, it's crazy because that wouldn't happen today, would it? Because now we got these phones in our pockets. We walk around today with computers in our pockets that have more access to information than the President of the United States had in his pocket on 12/31/99. We've never, ever had more technology at our disposal. And then you look at something like the plane, and here's the thing to remember is when we got the plane, then we said, well, we need airports. And now we need an industry that's building the tires for this and the fuel for this, and we need the mechanics for this. And because we've got the airport, now we're gonna need people to staff the airport. We're gonna need people to be pilots, to be flight attendants. Then we realized that we need more infrastructure in order to get to the airport. We need parking to be there, and then people are at the airport. Now it turns out they want some food there, and now we need security. If you think about these industries, you need to remember that when a new technology comes along, it's not just that thing. We have never in the history of this planet had more technology than we do today, and yet we've never had more workers. And we have a lower unemployment rate today than we did when this happened. It's kind of incredible when you stop and think about it. And then I start thinking about this, and this is my last slide, okay? But this is what it makes me think, is that we're constantly dealing with new technologies because we're constantly dealing with the next problem. We'll never run out of things we want to work on because we're not a complacent people. We constantly want to be finding the next thing. And it causes unrest and it causes anxiety, and there's pros and there's cons with all this stuff. But when I sit here and think about what's happened over the last 70 years, this doesn't go back to the beginning of Grandpa Dahl, right? Because he was in the 1920s, but as I stopped and I walked back generation by generation, think about this. In the 1950s, we're dealing with polio. And what do? We develop a polio vaccine, and then polio's behind us, but the vaccine moves forward. We don't lose the innovation, but we've passed the problem. And then you think about what happened we created microwaves and hard drives, and they were incredibly expensive to start. Then you get into the 1960s, and we said, well, with polio behind us now we got to worry about the heart issue, so pacemakers, coronary bypass surgery. And so what do? We innovate. And now all of a sudden people are living longer, and they're living healthier lives. But we also did communication satellites and high-yield rice. Nobody's talking about high-yield rice, and it had one of the biggest impacts on reducing global malnutrition of anything that's ever been created. We didn't see the impact of it because we live up here when they're here, but they felt it. And then I look at the 1970s, and we got mobile phones. How mobile were those mobile phones? And then what happened? They were incredibly expensive to start, and then we started making them better and faster. We started adding new features, and here we are today, and virtually everyone's got them. And then we get the web. We get web browsers and search engines. We get the Human Genome Project, iPhones and Google Maps. We've got think about this, reusable rockets. We are now sending hundreds of rockets into space every single year, and they go up, and they come down, and they get caught in these giant chopsticks. It's incredible when you stop and think about this thing. Now, do we have the flying cars that they were thinking about in the 1950s, the 1940s? No, but so much we have that they never could have imagined. And I look at this list and I think about every generation builds on the generation that came before. We're here not because of the politicians, we're not here because of the Fed, right? As I look out into 2026, here's what I think on the market front. I think it's gonna be a relatively flat year by the end of the year. I think you're gonna see some of those big names have a bit of a pullback, but you're gonna see a broadening out. You're seeing more and more of the small, mid-sized companies that are getting back in the game. It's showing up in employment. It's showing up in purchases. It's showing up in their earnings numbers. They're a major support on that overall earnings number. Okay, but from a GDP, it's going to be 2.5%. That's my expectation. Inflation, 2.5%. But as I sit there and I watch the data, I look at the monthly numbers and I think about, is it progressing this? Because when we're in here in 3 years and 5 years, as my kids who are 8 and 11, as they grow up, the things they have, the resources they have are thanks to you. Not what happened in Washington. They're thanks to the people who built each building block so that each generation that came after could build and build and build and build. And I hope I get to 102. And I hope I'm still driving the car like Grandpa Dahl is, okay? But if I reach 102, one thing I know for certain is the world is not going to look anything like what I think it will look like. It's going to be more incredible. It'll have its problems, but my kids' world and each generation, thank you for everything you did that it has us here today. Thank you for all the work that you put in, the effort, the time you've put in with family, with kids, with grandkids, with neighbors, right? What you do is so impactful. Thank you for everything you've done. Thank you for giving me some time here. As far as I can tell, nobody fell asleep, which is always a win in an economics presentation. I'm going to stop there, and then I think we're going to have some time for questions. Perfect. Thank you.
Perfect. Thank you. Yeah, so we're going to go ahead and start the panel. So I think we've got Andrew and Corey and Chip on their way down as well.
The Rocky theme music, perhaps. Hello, everyone. So this is your time for questions. By the way, I need to be quite honest. The size of the photographs is relative to the importance of the firm. So, just being humble. So we've got some folks, I think, is it Brian and Bob are walking around with microphones. They're going to move through the audience. Raise your hand, they'll grab one. I have a couple that folks asked me while they're getting ready, unless somebody's ready. If you're ready.
Question on the technology. I saw some technologies on there, like 3D printing, that actually I worked on in the 1980s. Mm-hmm. So what sort of technologies have you seen that are still in the research labs that are going to influence our economy in the future?
Yeah. No, it's a great question. It's like my dad worked in computer science. He did his PhD in technology back in the 1980s. He actually worked on the refractoring technology that gets used in AI today. By the time he retired, we hadn't gotten the technology to that point where it could really launch off. What I'm seeing the biggest gains on that are not being realized and out there yet, I think a lot of it is in healthcare related. They've realized ways, and some of that's using the new technology to better target treatment, to earlier identify what it is that's taking place. Now, that is a heavily regulated industry, incredibly regulated industry, right? And there are concerns about how quickly do we roll this thing out, but we have an aging population, so this is going to be a critical piece of the investment within the United States over the coming decades. Outside of that, there's been a lot of work on, to be honest, AI. I think there's a lot of opportunities within AI, but it's not a replacement for intelligence right now. And I'll tell you, right, you've probably seen this, it has its negative effects in the short term too. Like kids coming out of college today, I will argue, are dumber than they were 4 or 5 years ago, okay? And what I mean by that is I'll interview, right? I'll interview somebody and they'll come in and they've got an amazing looking resume and they've got great grades and a great paper, and then you ask them about that thing they wrote and they're like, and you're like, well, do you understand the content? And they'll tell us. They'll be honest. They'll say, well, it was a really competitive class and everybody else was using it, so I used it too. And it's like, man, it's a missed opportunity. You went to school, you paid a ton of money to go and get this education, and you learned how to use the tool, but you didn't understand the information that you need to be able to leverage. You need to know this information so you know whether that thing is telling you what's right. So I still think there's a lot on the AI side that it always takes us longer than we think. The internet, right? The internet took us, it did more than we imagined, but it took longer than we imagined. So I would expect this AI thing is going to be playing out over the next 5, 10, 15 years before we ultimately figure out the best uses. But medical is the area where I see a lot of the innovation, the investment that's happening today that you probably won't hear about for 10 or 15 years.
That's a great answer. I have a buddy who runs he used to run an ER for a hospital system out on Long Island, and now he teaches medicine. And he said the young doctors-to-be that he teaches are really great at researching. This is pre-AI, pre-ChatGPT, that they would use Google, that they were great at getting answers, but they weren't necessarily great at understanding the answers. So it's interesting how this technology provides similar inputs on the front edge, but then it levels out. And I had a former CEO of one of my prior firms make a comment that stuck with me. This is several years ago. And he said, when you think about technology, the world that we live in has never moved as fast as it moves right now. Everything is so hyper speed. I mean, information. Nothing has ever moved this fast, and nothing will move this slowly again. So it's kind of interesting when you think about it. All right, do we have another question out there?
I got you.
All right,
Let me use my mic this time.
there you go.
Thanks, Brian.
I'll test it. Are the slides that you just showed going to be available?
Yeah.
Okay.
I can make them available. Yeah.
Because some of those I love, and I would love to share them.
Yeah. I'll get them over to the team as soon as we're done. Yeah.
Perfect. That's my
That was a
question.
softball question. Way to go. All right. Thank you, ladies and gentlemen. Bob, you've got someone over there?
Yes, I'd really like to know what Grandpa ate to make it to 105.
Italian beef, deep dish pizza, and cherry pie. Funny enough, and it's that, and he goes out to the same diner almost every morning. You know, I think we asked him that. We're like, Grandpa Dahl, you know, obviously some of it's genetics, but he never stopped moving. He still lives at home. He's been retired now for 40, 50 years.
Wow.
But he builds birdhouses. And he reads a lot of books. And he's like, I had to keep the mind active. He said, when I watched my friends, when they stopped trying to learn, is when everything slowed down and it kind of fell. And he told me one thing one time. He said, Andrew, we don't stop playing because we got old. We get old because we stop playing. He said, always be excited. Always learn something, because if you have that motivation to keep going, to wake up the next morning because you're excited about what you can still do, it keeps him running. And I hope he's here for a while longer.
I have a question over here.
Yeah.
Thank you, guys. So I'm still working, and one of my interesting things I'm seeing is more data centers being introduced into the lending market where I work, tied specifically to AI. And so, you know, thinking about, was it 6938 that's going into effect this summer? I'm curious how that rush of infrastructure for those data centers is going to impact the market, and then ultimately, you know, having enough energy and infrastructure to support this massive AI industry that we see rolling towards us.
Yeah. No, it's a great question. So when we talk with the data centers, they're being built around the country. A lot of this started 1, 2, 3 years ago. I'll tell you that from the side of not the Apples, but the Amazons, the Metas, the Googles, they already have the chips ready to use them when the data centers come up. Like, as soon as the data centers are available, they'll take them. The question has really been around the energy infrastructure and cooling infrastructure surrounding it. Now, that's got more companies involved, right? It broadened it out because Amazon doesn't build the cooling facilities. That's gotten more and more companies. If you go out to New Albany, Ohio, and by side, I would not go to New Albany, Ohio on vacation. Okay? But if you found yourself in New Albany, Ohio, it's where the $20 billion Intel plant is going in. And you'll know as soon as you've rolled into town, because again, there's a massive infrastructure around it. They needed to house and feed the construction workers. It's bringing more people that are going to work at these facilities, so they're building up the school systems. The energy has been the major question. So what they're doing right now is saying, can we build off-grid? Right? Because the existing infrastructure that's tying in, let's say, to the town, if they just hop in there, it's going to push energy prices up. It's competition for it. And what they've been told by some of these areas is, if you can get nat gas there, or you can bring solar panels, and you can bring generators, and you can create your own grid while the other grid is being built out, you can be here. And so that's what they're doing right now. Now, that is our limiting factor. China, when you look at AI in the US versus China, they don't have the same level of chip. They don't have the same level of design understanding, and they also don't have the free access to information, which is critical, right? It's so heavily restricted there. But one of the major things that China has an advantage of is they've got massive energy. They've grown out their energy 9 times faster than the US over the last 2 decades. So you may see fluctuations in energy prices, but as soon as it's available, it'll get used. And companies are going to, their back's on the wall, but there's an opportunity. They're going to innovate massively, and that's going to lead to revenue in a lot of areas.
That's a great point, Andrew. One thing I just wanted to mention as well on top of that, an underlying impact from that, not only energy, but you mentioned the IBM plant. And so this process of the industrial, what we call reshoring as well, which there's a reason why we've seen, a flat S&P or a little bit down S&P so far this year from a market performance perspective, but we've seen energy, we've seen industrials, we've seen some specific sectors really actually showing some positive performance year to date. And so, that kind of speaks to, and you guys have probably heard us talk about this a lot, but it really speaks to, some of the changes that we've made in our portfolios. And these are not changes that we've made, in the last month or quarter even, but stuff that we started to see, 2 years ago, that we said, how do we start beginning to reposition our portfolios in anticipation of some of these things? But just wanted to mention that in addition to, Andrew, your point.
And to
point,
speak
Jacob.
to what you're saying, Jacob, with the portfolios, I mean, a lot of these that we're looking at today, the more aggressive the portfolio, typically there's more tech in that portfolio, and the S&P is relatively flat on the year, but it's so interesting about what you say about the setup over the last year is that when we look at the more conservative portfolios or broadly diversified portfolios, they're outpacing the S&P. I mean, and we don't get that often, but it's nice when that happens. It just speaks to a lot of the good management that we've done behind the scenes to put ourselves in that position.
And they tend to consist of more of I call it the boring areas of the stock market that really have lagged for the last 3 to 5 years compared to tech and AI and semiconductors and all of that. But we are starting to see a little bit of a rotation there. And when I say boring, I mean that in an endearing way. They're certainly rising to the occasion.
Yeah, 26 is a year where boring's been beautiful.
Yeah.
And a lot of that is the technologies we need no matter what. It's been a bit of an anti-disruption trade too. These are core services, core things we need no matter what.
One of the questions we got before we came on was, are we in an AI.com bubble? And I'll throw that out to you folks. One thing I would like that I think about is, I remember the .com bubble, and there was build out, especially around fiber optic cable. And here we are, how many years later? 20 some odd years later. And I don't think we've used all the capacity of those fiber optic cables that were laid in anticipation of the internet, 2 decades ago. Whereas to your point, as soon as these facilities come online, the data centers come online, they're grooving. They're at max capacity. So which one of you wants to field that question about the AI bubble?
I'll take a stab at it, Chip. Thank you. And you guys feel free to add color commentary. But the thing that I'll point to, because we have gotten this a lot, and I think it's there's a lot of noise around it, which is you've got one, are we in an AI bubble? And then secondly, are we also tracking kind of similar to where we were with the .com bust? And I would say there's a lot of differences. I think probably the one reason why most people are saying, hey, are we kind of in this AI bubble craze, is you're starting to see the level of debt that's being added from these specific companies in AI. And Andrew, you alluded to that. I saw a stat just this week where it was for 2025, these big tech companies basically account for a third of the debt generated in 2025. So it's a big number. But we've got to remember, these are big companies. I mean, the Mag 7, basically accounts for roughly 30 to 40% of the entire market, just depending on where they're at any given moment. So there's a lot of difference there. And then I think the other difference, again, from my perspective, is when you look at the .com craze, money was going into companies that didn't do a thing and didn't make any money. And there's a real difference in that as to where we are today. These companies that are adding debt to the books, they've got numbers to back it up. They've got earnings. They're great companies. They're companies we all have heard of, we all use on a daily basis. And so I think there's a real difference there from my perspective, but I don't know if you guys have any thoughts
no
too.
intrinsic value back in the .com bust. So again, speaks volumes as to why that bubble eventually popped versus what we're seeing today. Earnings are matching the demand and what we're seeing from a pricing standpoint as well.
Right.
And if that were to happen, or we wanted to play that scenario out, I mean, I would encourage you to ask us to stress test your portfolio when you come in the office. So we've got software that we use, the AI bubble. I think what it says is what happens to your particular portfolio that you're invested in if the S&P falls 15% and semiconductors fall, stocks fall 30. That's going to involve a lot of these tech companies and semiconductor companies. And we can model out to see what we would expect the portfolio to do over that time period. And I think a lot of us would be surprised to understand that the way that we've built these portfolios out, we may not have the type of exposure that is as worrisome as we think we do. So I would encourage when you come in for a review, ask that question, because it's a very easy thing for Andrew or Jacob or I to pull up and walk through with you.
Good answers, guys. Thank you.
Question related to generational wealth, social implications that are there, and housing crisis that's going on for the young people that can't afford housing. I'm just curious how you see that affecting markets going forward, and as we greedy baby boomers die off and that generational wealth changes hands, how that's going to affect that.
You want to field that one?
I can take the housing side of it. The generational, I'll leave you guys to the generational wealth. On the housing side, we do have a housing shortage right now, right? And there's a couple of reasons for that. One is that if you go back, we need to build about 1.5 million homes per year given population growth, scrappage, natural deterioration. Go back with me to 2003, 4, 5, we were doing 2.4 million. We were overbuilding, right? In the lead up to what ended up being the housing crisis. When the housing crisis happened, and we got the collapse in 07, 08, 09, we saw mass exodus from the construction industry. So we were building about 600,000 homes per year, and we didn't get back to 1.5 million until the beginning of COVID. It was the end of 2019. At that point, we had a 3 million home shortage. Then what happens, right? Then we go into COVID, and interest rates drop below 3%. So what did everybody do? They refinanced or bought a house. Now nobody wants to sell a house. Nobody wants to give up a sub 3% 30-year mortgage or 15 and take on something at 6.5. The other problem, though, that came from that is that when we had low interest rates, the home builders said, well, you can afford more. We can build bigger houses. You can now afford, for your level of income, with a low interest rate, lower interest payments, you can afford a 3,000 square foot home instead of a 15. So they started building those. And they built them, and they built them, and they sold, and they sold, and then interest rates went up, but they were building the larger homes. And as those came on the market, they weren't finding, the younger generation couldn't buy them. So the younger generation today, I would expect to see this over the next 2, 3, 4 years. And I'll tell you, there's echoes of what happened in 78, 79, 80 when interest rates went up and afterwards with the housing market. We saw the same lockup with housing stock. Home builders shifted to what they were building to accommodate that group of a younger demographic. So the houses are shrinking again. They're going back to smaller size, smaller lots to make them more accessible, and interest rates will continue to. I mean, I look at the interest rates and at 6.5, right? I do a talk each year in Chicago for college seniors that are working with their investment things with their colleges. And one of them asked me, they're like, how am I ever going to afford a home at 6.5%? And I said, call your parents.
Right.
Ask your mom what her interest rate was on her first home. And he found me afterwards, he said, 18.5%. And I said, yeah, call your mom more often. It's one of those, people adapt to it. And I do think the rates will start to come down a little bit. The 30-year mortgages tend to be more on the 10-year than they are on the short end of the yield curve. So as the Fed is cutting rates, it won't have as big of an impact. We need to see the longer duration, and that has more to do with getting debt under control, getting spending things down. And if we get that and the home builders start to move, you'll see it. But we have a massive demographic of 30 to 39-year-olds that are at prime home buying and family formation age that are ready as that comes online. So.
And we saw also a bunch of years ago that millennials weren't buying homes. And that was the cause for concern. They're not going to buy homes. Homes are a great investment. We got to get them in homes. Homes are a great investment. So typically the housing market moves up in value at about 3% per year, and the S&P does a lot better than that. And so when we would talk to clients, sometimes we say to them, yeah, a house is a great investment, but my portfolio, I don't water it, I don't wallpaper it, I don't paint it, I don't have to have the HVAC guy come out, I don't pay taxes on it every year. So there needs to be a perspective between the illiquid investment pocket, which is your real estate, and the liquid investment pocket, which are your portfolios. As far as the intergenerational wealth, that's an interesting conundrum, because the one thing none of us in this room know is when we're going to die. And I don't think anyone here wants to say, you know what, I love my kids so much, here's all my money. So, will that wealth transfer happen? It will, but it's going to happen over time. And there are ways that these fine gentlemen can structure portfolios and trusts so that we can predict and plan for what that growth would look like for the next generation downstream. Does anyone want to touch on that?
Yeah, I do. Time is your kids and your grandkids' greatest asset that they have, not the amount of money that's in their account, not the job that they have, but the time that they have. And, you know, a lot of us may be in a mindset that we want our kids to earn their way. We want them to make their own way and not spoil them. And I think the general consensus a lot of the times is, hey, we may have excess capital that we ourselves are not going to spend, but we're going to wait until we die and then they will inherit it. And the issue with that sometimes is that when we're typically inheriting assets, how old are we? 50, 60, you know, number one, our lifestyle's already set. We've probably already figured it out. Number two, the amount of time, additional time that money has to work in the types of investments the younger generation wants to do is a lot less. So I would argue that a $5,000 or a $10,000 gift to a child or a grandchild that's in their teens or their 20s has a lot greater impact than leaving them $500,000 to $1 million when they're 50 or 60. And so the giving doesn't have to spoil. It can be done in creative ways. It's not cash, but maybe it's paying for something, for school, helping with the down payment of a house. But that capital allocation, the younger that happens, the more impact it's going to have for the child. The one thing somebody asked me about earlier was, when we were outside, was Trump accounts, you know, the new investment accounts that they have created for children. And the initial investment in those Trump accounts that they're going to allow in the first year is $5,000. If you were to put $5,000 in an account when a grandchild or a child is born, and you were to never touch that account again, and it was in the S&P 500, that account's worth $500,000-$600,000 by the time they retire. That's the power of time. So I want you to enjoy your money. That's why we're here, to help you enjoy your money and spend it and make sure it's sustainable. But a lot of the times we're having conversations with you guys, we're not going to spend all this money. And we want it to serve a purpose that's important to you. And if family is important, we want to have that discussion about the creative ways we could do that from a tax standpoint and a timing standpoint.
Can I pull on that thread a little
Chip,
bit?
after Andrew, one more question, please.
Let me pull on that thread a little bit further, because this is all great conversation. And again, oftentimes when we're thinking about multi-generational wealth, yes, we're also thinking about someone having to pass away in order to pass those dollars on. And you hit on a good point. What I'm seeing a lot of younger investors, maybe recent college graduates, just started their career, this idea of starting the American dream and buying a home. And you know, yes, the market's changing a lot, but this American dream, it's pretty far-fetched for a lot of younger individuals, for a lot of younger Americans. And this concept, we've talked about it for any of my particular clients out there. You've probably heard me talk about this. Chris has talked about it on The Wealthologist, but there are certain accounts that we have the ability to gift to our minor children or grandchildren, known as UTMA accounts. So this is different than Trump accounts. Trump accounts are going to be geared towards retirement purposes. Now, UTMA accounts can frankly be used for anything. And this allows a parent, a grandparent, to on an annual basis give to this child, to this minor, so that over time, again, we can parlay financial literacy lessons to this gifting strategy as well. I do it for my kids, where every year we're giving them X amount to their UTMA accounts, and every year we're having a conversation about what stocks they want to buy. And it's so cool to see their little minds working, because frankly, I don't know about you guys, but I was never exposed to any of this until my college years. And I'm seeing the same disservice for the younger generations as well. So it's a way that we can gift with intention, maybe to allow this American dream to be accelerated for our younger generation. But also, I would encourage all of you to parlay these financial literacy lessons. And just to give you an example of how I'm doing it with my kids, my son Easton, I don't know how many people in here have met Easton. I know you guys have. Easton's now 9 years old. You guys know him pretty well. Every article of clothing that Easton has a Jordan logo on it. Pants, socks, sweatshirts, you name it. And so we'll have a conversation about that. Easton, the parent company of the Jordan brand is Nike. Are a lot of kids in your classroom also wearing Jordan logos on their clothes? Do you think that that would be a good company to own some of their stock? So again, parlaying gifting with financial literacy, I think that will, over a matter of 5, 10, 20 years, go a long way for any of you that have gifting intentions.
That's
How's
great.
His portfolio doing against yours?
His portfolio against mine, not so well, but Isla, my 6-year-old daughter, is crushing my portfolio. at the moment. That will change over time, I'm sure.
Good stuff. So we have time for one more question. Going once, going twice.
Yes, I've got one here. Can you speak to the use of robotics and the effect perhaps on companies' earnings that are getting heavily involved in robotics?
Is that for manufacturing or is that
Manufacturing,
like,
yes.
Okay, thank you. Who wants to field that? That sounds like it's up your alley.
Yeah, so I do watch what happens in the robotics. Now, robotics have been happening here for a little while. Like if you look at automation, Amazon is one of those companies that started using it in their sorting facilities. If you look at it in the auto space and you were to go, let's say, to BMW's facility that they have in Spartanburg, it's pretty incredible the level of automation that they have in here. For the general store, or a lot of the manufacturing, they're still in the process of doing it. Now, what it has done is it's improved some of the margins in that space. If we look at, I watched it in steel manufacturing. I did a study on that one because there was a lot of questions on how it was going to impact employment. In those, it increased the output per employee, and it did lead to some reallocation of where those employees were at. And this is a big question that's coming up for a lot of places, is because manufacturing jobs, you think of these as like the traditional, especially I'm from Chicago, I'm from the Rust Belt area. A lot of areas are nervous about that if there's a shift and there's robotics. But again, what we've seen in those areas is then they take people that were working on the floor and now they help manage the machines and they help do some of the repairs and stuff on the machines. So from an investment standpoint, those companies have seen improvements in their margins. It hasn't led to big shifts in terms of their employment numbers, but it has boosted their output. And so what it's done is it's brought pricing down on the thing that they're producing, which at the end of the day, we look at that. And a lot of times we don't see it. You know, a steel manufacturer does it, and all of a sudden aluminum can cost less, and you don't notice it, but it dropped the cost of something at the grocery store by 5 cents. It's a knock-on effect that we don't really always line up. But that's what I'm seeing. I don't know if you guys are seeing anything.
Would you say that's analogous with what we may see with AI? There's a lot of fear with AI replacing jobs, but those jobs will shift, and just like the people that work on robotics?
I think they'll shift, and that's the history of innovation, right? Is that if you think about We've never worked less manual labor than we do today. As a sheriff, I mean, you go back 100 years, and actually about 150 years was the last year, 1890s was the last time that agriculture was the #1. It was over half of the population of the United States. Was it that everybody wanted to be farmers back in the 1800s? No, right? It's that's what you had to do in order to have enough food to be able to live. And as soon as we figured out more advanced methods of producing, it allowed us to work on other things. And somebody says, okay, well, if you can make the wheat and the zucchini, I'll make new shoes. And then it leads to abundance. And with the AI thing, I think it will be the same thing. We never run out of things that we want to work on. It's just, do we have the time to be able to do it? Do we have the resources? Do we have the skill? Do we have the technology that allows us to try to do new things? And whether that's improvements in healthcare, today, we do less manual labor and we work less hours in total. We've got more leisure time than they did 50 years ago, 70 years ago. Now we feel like we're always connected, right? Because of choices that we make. But at the end of the day, it frees us up in things we want to do. And I think both of those, and robotics is going to come, again, years down the road, more general robotics. I think you're going to continue to see movement in those spaces.
Great answer. So how are we doing on time, folks? I can see Bob, Chris.
We're wrapping up, I believe. Wrap it up.
Okay, well, this was our esteemed panel, ladies and gentlemen. Huge round of applause, not so, but huge, come on. Thank you. Great job.
Thanks, guys. Thank you. All right, well, thank you guys. That was terrific, and thank you guys for those great questions. I know there were more questions. Unfortunately, we got to get you home at some point. But again, I want to, before we wrap up, just want to give you a thanks again for being here. As I'd mentioned before, it's always nice to have you guys here. For us to put in front of you our advisors and also one of our guest speakers. Again, another quick round of applause. I think Andrew is heading out the door quickly, so thank you to him. I think that insight was really good. You know, there's a number of things up there that kind of floor me. I was actually just looking at a research report. We were talking a little bit about real estate, and what was interesting to me is the Charlotte real estate market as well. And I wish we could have talked a little bit more about that, but I was actually really floored to find out that new home starts in Charlotte have been dropping 20% per year for the past 3 years. I always hear that Charlotte's growing, 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 and we're booming, but we're not keeping up with that. So just something kind of interesting to look at. But anyhow, that's my thing. I miss being up on the stage talking about this stuff, so I got to throw my little 2 cents. So a couple of things that I want to touch on is, first, I do want to thank the team for all the work that they did today. Jacob, thanks for the introduction. Guys, thank you for all that you did. Brian and Bob, thanks for doing the questions. But I really want to thank the team behind the scenes that helped with everything, and this was really led by Kim. So many of you guys know Kim. Kim did a great job. This was her vision to set all of this up, put this panel together and do that. So thank you, Kim, wherever you are, for everything that you do to make the clients and the team feel great. And one last thing I want to mention, and this was interesting. I don't know who asked the question about generational money, generational wealth. Somebody asked that question, and it actually leads into one final announcement that I wanted to make. And it's there is a sheet that you got when you came in. So you probably got a sheet that mentioned maybe something about, yeah, that sheet right there. Thank you for advancing that to me. What this is one thing that we heard from so many of you is, for a lot of the next generation, you guys are wanting to have content for them or have ways for them to be educated. And quite frankly, they may not be in the world of wealth management yet. One day they may be, but you still are interested in having them get that education. So what we decided to do this past year and going forward is really kind of split two segments of Hobart Wealth that we've been building. We've got Hobart Wealth, and then we've got the Wealthologist. And Hobart Wealth, for all of you, this is the wealth management platform. This is the folks that you just heard from. It's the client service team. It's your assets. It's the money management. It's the financial planning. It's all of that good stuff, and that's going to be consistent. The thing that's going to be changing a little bit is we're actually going to be taking the Hobart Wealth, the Wealthologist side of things, and we're going to be broadening that out. So instead of that being kind of what it has been, we're actually going to make it much more evergreen in nature. We're going to have a lot more topics that are great for people that are retired, nearing retirement, but we're also going to be having more content that is going to be built for your kids and your grandkids, so that you have the ability to share with them and have those good conversations at the Thanksgiving table about different areas of conversation. And we're going to encourage you as well, as you're having those conversations, you can always have a family meeting in our office as well. And that's where you get to come sit down and talk with the advisor that you're working with, as well as your family, and begin to have those conversations about what's important about wealth. I think you guys brought up some great concepts as to as how to pass on wealth and what it means. And I think the best thing when it comes to passing on our wealth is the wealth associated with knowledge. So that's going to be one of our big investments this upcoming year. The piece of Hobart Wealth that I'm really excited about is kind of over in this area, because Hobart Wealth and the Wealthologist has been a lot of Chris time. It's me in front of a camera, and sometimes you guys probably get tired of seeing Chris. So what we're going to be doing this upcoming year as well is we're going to be introducing a lot more of the teams. So you're going to see our client service team answering different questions for you. You're going to see Corey and Andrew answering questions, and we have a new podcast coming out that is all Jacob. So we're excited to have that coming out, so you guys will be seeing that coming as well. Again, our goal for all of that is just to provide more for you through the Hobart Wealth side of things, that deeper knowledge and education. And again, I'm going to encourage you that as you have more questions, send them to us. This year, as I said, it's our year of education, where we're going to be focusing more on what's important to all of you. So let us know what's important so we can really, scratch that itch. All right, folks. This wraps up our day. I hope it was helpful for you. I hope it had some good information. If you do have questions, the guys and the rest of the team are going to be here for the rest of the afternoon. But again, thank you all for coming today. Thank you for participating. Thank you for the great questions. And thank you for putting your trust in the team at Hobart.